Market stumbling around today, really still trying to deal with the Fed chairman that apparently woke up yesterday and decided to choose violence, right? The man that helped to build our Potemkin village of wealth and prosperity. Now, he's the one driving the wrecking ball to rip it down. And by the way, he's taken off the governor. There's nothing stopping this thing. I want to bring in now Slate Stone Wealth, their chief strategist, Kenny Polcari, along with Crossmark chief investment CIO, Bob Dahl. Both of you guys have been bracing for this in your own way for a long time. So maybe the move in this market is not a surprise, Bob. I mean, but this epiphany maybe by the Fed has caught a lot of people short, and everyone's wondering what boxes have to be checked to get us back. One you've talked about a lot is labor. This morning, initial jobless claims came in, 7th week in a row. They beat Wall Street consensus. How far down the road is all of this going to take?
You use the word patience in your opening. I'll repeat it. Patience. These things take a long time, as you know. What affects us in the markets is kind of boom. But the real economy, it takes a long time. They only have a blunt instrument called interest rates. They don't have a scalpel. They can't go in and pick and choose what they're going to slow down. They have to keep at it. That's part of the scary part and the frustrating part.
Well, according to their new the summary of economic projections, that blunt instrument is working, and they recognize that it's working. I mean, they went from an economy, I think, at 1.7% GDP to 0.2%, right? They'll never say recession. I've never seen a central bank say, yeah, we're going to have negative growth. But with that in mind, then, it feels like they just woke up to a degree.
Well, I think they just woke up and they realized, and that was evident in his press conference yesterday, right, when they raised the terminal rate to 4.6, up from the 4.25 range, and then they basically promised that we're going 75 again in November, which will be the 4th time we've had that 75 base point increase. And I think that says is we're a little bit more concerned. It's not responding as quickly as we'd like it to, and we need to remain aggressive. And I think that's why we saw
all the things that changed, though, right? Well, GDP, unemployment rate, terminal rate. Was it the terminal rate that impacted this market the most?
I thought it was the terminal rate and the fact that in November we'll get another 75, because everyone was convinced, this is going to be the last one, then he's going to 50, and then it's going to be nice and nice. It's not going to be so nice.
So, Bob, I'm sitting here in the studio with Daniel DiMartino Booth, and we're looking at each tick. And it felt like the market, because you remember the markets rallied the last 4 or 5 times the Fed got together, and even when they hiked rates. It looks like everyone gave up the ghost when he said no soft landing.
Yeah, exactly.
I mean, that was it.
For 2.5 minutes it rallied. Then what happened after that?
But this is it. And even the Fed is saying, listen, forget it. We're not even going to play that game anymore. No, it's going to be a hard landing, and there's no way to avoid it.
Yeah, he said that we're not going to be able to land the plane without a lot of damage.
Right.
They raise their estimate for rates. They lower their estimates for growth. That is not good for earnings. That's not good for the economy. It's not good for the stock market.
And that's a sea change versus what he had been saying.
Exactly.
It was going to be soft. We have it under control. Don't anybody worry. And then suddenly we're crashing.
Evidence the June to August rally. People kind of hung on to, maybe they're getting close. Maybe we'll get a pivot.
Right.
Not to happen.
But here's the interesting thing, though, right? The CME Fed Watch and other measures of guessing where the Fed's going to be and where rates are going to go, they were already there. I mean, the Fed finally kind of caught up with the CME, and that's what makes this reaction sort of curious. There hasn't been a lot of changes. In fact, if you look at the same CME Fed Watch, they're marking for rate cuts next summer. So is it just the fact that the Fed has now capitulated there's no more hope? There was a sliver of hope. Now there's no more hope.
I think you can jump in 1 second. I think the quick reaction happens with the algorithms, right? Because the algorithms scrape the headlines. They see the words that are there. They can't really understand the intonation of the word. And so the algorithms react in a certain way. The buy side gets canceled. There's avoidant prices. Stocks collapse, which is exactly what you saw yesterday afternoon, the minute he said it.
Absolutely. And what I'd say beyond that is nobody knows.
Right.
So next meeting, we may get something different. We're going to get another inflation number. It could be better than expected.
So we're truly data dependent right now.
We're data dependent and an uncertain period.
If that CPI number, Bob, had come in with a 7 handle, 7.9, would this be an entirely different conversation right now?
It's somewhat different, but not entirely. We still, whether it's...
I mean, the market would have gone up that day. We were up 4 days in a row. The futures were like champing at the bit.
It would have been better, no question. But the 7 handle, 8 handle, they want a 2 handle.
Right. We're not
It's a
getting
big gap.
Yeah. We're not getting the 2 by March the way some people think.
So let's talk about, guys, what people really want to know at home. Then how do we navigate through this? I mean, I've heard you, Bob, say talk about lower beta names, higher dividend yield, that kind of thing. Is that sort of the roadmap right now?
I think so. If you're defensive like we both are, you need to be careful. You don't go zero in stocks, but the ones you own have to have some defense.
Right.
A little bit of yield, good cash flow, good balance sheet, earnings predictability. I'll use the word quality.
Well, I'd say big, boring, and beautiful, right? Because that's what they are.
Too.
But listen, again, because you.
I would say that was you, but not with that jacket.
No, well, listen, I wore my green today, right?
Look who's talking about
No, I don't really. Look who's talking about the color. But I'm kind of hoping the market goes higher. I wore my green, right? But again, it depends on where you are, right? In the life cycle. If you're 25 or 30 years old, you've got 40 years to really ride this out. And so there are great opportunities in some names that may not appeal to me, but certainly would appeal to you.
There is no 20-year period in U.S. history where stocks haven't gone up.
Right. Exactly.
So then on that note, I want to get a little granular because quality is this year's barbell. Last year I hated when the guest said they did the barbell approach.
Right.
This year is quality. I don't know what the hell that is. Someone even had high quality. I'm like, huh? To be more specific, you're saying like HMOs and old tech.
I think they have higher predictability.
They've been around. They've been through all of this.
Right.
They
Know
have
how to do it.
predictable business, cash flow, strong balance sheets.
You hit the nail on the head. That's exactly right.
right.
You want a management perhaps that's been there before,
Right.
a management team that's been around for a while. Earnings predictability is another variable. You want that to be high in this uncertain environment.
Kenny, I got 30 seconds. What do you have to add?
No, so I think he's absolutely right, and you have to look at things like
What about
utilities.
this? What about like someone you're holding an Apple, for instance?
Yeah, and I'll buy more Apple.
So buy more. You don't sell. That's quality.
Apple is one of the
That's
names I am
quality.
not selling. Right,
Okay.
but I'd sell the Roku and the Teledoc and all that stuff. But I'm buying Apple. I'd buy Microsoft. Right.